You guys want to see something crazy? Changing this one thing by 0.5% can impact the market by over 20%. This is not only the stock market, this can be in cryptos as well. And of course, it's not the only metric and only factor to this, but it plays a huge factor. I'll go and explain it to you guys later in this video, but in today's KuCoin DigiDive, we're going to be talking about the federal funds rate and how it correlates to the markets, how it correlates to crypto, and how it correlates to the economy as a whole. If you guys would like to get started trading with KuCoin, links in the description below, and you guys can get 20% off trading fees. All right, so let's go into this chart. I'm going to show you guys a couple of crazy things. We're actually going to use the time frame on the 5-year chart. Let me go ahead and show you the first one. We just experienced this now. I'll explain it later in this video why this has a effect on it, as well as a infographic video so you guys can get a summary of it. As you guys can see here, the federal funds rate, it says 0.2, but we're going to go way back. We're going to go to 0.08. We can call this 0.1 if we wanted to, which at its peak was around 4778. So let's go and get our handy dandy trading view chart out. As you guys can see here on the trading view chart, if we take the peak, which is 48.28, and all the way to the trough to where our interest rates changed, as you guys can see here, our interest rates are now 0.74%, which is a 0.6% increase, just about. Let's go ahead and take our ruler and see how far of a drop this was. If we go from the peak and go all the way to the bottom, you can see here this is a 21.61% drop. Now, I know you're saying, you're like, Drake. No, that is only a one-off situation. It's never ever happened like that. That's like one and done. Whatever. Okay, fine. Let's go ahead and go to 2018. You know, where we previously had that other drop. It's kind of hard to see now that we've been skyrocketing. But in 2018, well, in the middle of 2018, we actually dropped from 29.30 all the way down to 23.28. So let's go and see how much of a drop this was. If we go from peak to trough, you guys can see here, this is 19.72. It's actually almost 20%. So let's go and see what the interest rates did at that time. Did they increase? Did they drop? I don't know. Let me go ahead and show you guys. So if we see here in 2018, right before the drop, which was right here, you can see the interest rates were at 2.19. So what did they increase the rates to at the end of the drop? Well, as you guys can see here, the rates, they went to 2.40. So changing a rate from 2.19 to 2.40, that's only a 0.2% change, caused that much correction. Now, okay, fine. We'll be on the safe side. We'll be on the fair side. Let's go to the previous bar. It was 1.95. Okay. 1.95% to, what's the next percentage? The next percentage ended up being 2.40. So that's almost a 0.5%. And what correction did that 0.5% cause to the market? Let's go and take a look back at what we just drew. Almost a 20% correction. Now I know what you're saying. You're like, Drake. Okay, that's only two circumstances. Okay, fine. How about we go in reverse? Let's see what happens when we decrease the rate to see what that does on the market. Does it make it go up 20%? Does it make it go down 40%? I don't know. Let's go ahead and show you guys. So if we go back to the chart, we're going to go from the peak interest rates, which was around the peak of this price. You guys can see here, we had a peak of about 2.4%. So if we drop the 2.4 interest rate percentage down to where it came down to, 0.05, we can basically call this 5 times. So if we take our 20% movement times 5, it's about 20%, guys. Remember, it's not exactly, and it's about times 5 because it goes to 0.05 from 2.4. You can round it off, whatever. This isn't exact. The point is to show the correlation between interest rates and the markets in general. Let's go ahead and see where we end up after this. When we drop the rates. So to sum up what we just said, from 2.4% to 0.05, we should be looking for about 100 to 110%, maybe even 115, because there's going to be fluctuations. It's not going to be exact. Let's go ahead and see what we get. Let's go ahead and grab our ruler and draw from the bottom. and we're going to go all the way to the top. As you can see here, it's 109%. Okay, so I can't make this stuff up, but the correlation is as interest rates drop, the markets go up. As interest rates rise, the markets go down. Well, why in the world is that? There are a couple of reasons for this, but interest rates are important for the markets. Borrowing becomes either more expensive or less expensive, depending on if the interest rates go up or go down. Tell me what you guys think in the comments below about interest rates. Do you think they're legit? Do you think they matter on the market? What are your thoughts? So let's go and talk about the interest rates dropping. Now, if they drop, what happens? The interest rates that you can get on your money at the bank drop. So you now have investors that are like, hey, I can't deposit my money into a bank or go get some bonds and earn a really good yield. I need to earn some money on my money because it's just being wasted away because inflation. So you have investors who are just sitting on their hands. They're like, I need to invest in something. I got to buy something. So they either buy stocks. When you press the green button, that causes the prices of things to go up, or they buy cryptocurrencies or other assets. Remember, the word is assets. When they're buying these assets, that causes them to appreciate just because of a common thing called supply and demand. As more is being bought, less is on the market. Supply and demand causes things to go up. That's normally how it works. Now, another thing is the cost to borrow is much lower. So this allows for cheap leverage into the system. What do I mean by this? Well, let's say, for example, in DeFi, I have some Ethereum or I have some Bitcoin. And I'm like, I don't want to sell it, but I'm missing out on this thing over here called DeFi. And everyone's speculating they're buying some pancake token or they're buying some hot dog token and they're making millions and millions of dollars. And I want to participate in that. So with low interest rates and you bring them to DeFi, what you could do is you could lend out your Ethereum. And let's say, for example, the borrow rates are 0%. That means you can borrow some cash at 0% and speculate over there. And at the end of the day, when you want to close it out and repay your loan, you would have had no interest to be paid. Or if it's extremely low interest, the cost for speculation is cheap. However, if that interest rate is 100% per year, you know if you take out that loan and hold it for 1 year, you're going to have to repay double what you owe. That's why it's always enticing when credit cards are like 0% interest on your first 6 months and all kinds of garbage, because everyone understands the cheap cost to borrow is amazing. It's a drug and people can't get off of it. However, when those interest rates do rise, people quickly repay their loan or they default. That's normally how it rolls. That's why you also have these corrections, because the ones that default, they cause this cascading event when they default that causes someone else's default, boom, and it breaks the system with leverage. That's why you see charts like this, and they usually fluctuate around the interest rates. It also goes for companies as well. Just like it goes for me, goes for you, goes for small investors, the same thing happens for stocks and companies. The cost to borrow and the cost for doing business is now more expensive because they're having to pay additional yield or additional monies on the money they borrow. Even the companies that are operating on razor thin margins, a 1 or 2% fluctuation in interest rates is huge. That is the difference between making earnings or just completely getting wrecked on earnings. Like I showed you, a 0.5 to 1% interest rate change can actually change the market by over 20%. That is just a 0.5 to 1%. That's tiny. Anyways, let me go ahead and show you guys this cool infographic, because infographics are cool and it'll sum up what I just told you guys.
Investors should observe the Federal Reserve's funds rate, which is the cost banks pay to borrow from the Federal Reserve banks. By increasing the federal funds rate, the Fed makes money more difficult to obtain, effectively lowering the money supply. This helps control inflation, which occurs when too much money chases too few goods, causing price increases. A ripple effect ensues when banks don't borrow as much from the Fed. It starts with banks increasing loan, credit card, and mortgage rates. Consumers have less money to spend, so businesses see smaller revenues. Borrowing also becomes more expensive for businesses. They don't borrow as much and must pay extra interest on their loans. They spend less, causing profits and growth rates to fall. If a company cuts back on growth spending and makes smaller profits, its estimated future cash flow will drop. This also lowers stock prices, which could potentially cause the market to fall. Most investors don't want a declining market. When expectations for growth and future cash flow decrease, stock prices don't appreciate as much, and owning stock becomes more risky. Investors expect risky investments to return a risk premium, which is the return above the risk-free rate an investment should yield. But remember, a higher federal funds rate also increases interest rates for safe investments like treasury bonds, making them more desirable.
So, closing thoughts. As a general rule of thumb, when the Federal Reserve cuts the interest rates, this is degen mode. This means stock market goes up, crypto goes up, assets go up because it's a cheaper cost to borrow, and you have leverage also starting to come into the system. However, when the Federal Reserve increases interest rates, the cost of capital becomes more expensive. It causes the stock market to go down because people repay their loan, they deposit money into the bank, they stop buying assets, and that usually causes a spiral if there is leverage into the system. Keep in mind, this is not a guarantee how the market will react. This is just an example and a demonstration to show you several times it actually affected the markets in general. There has been a proven correlation between interest rates and the stock markets. It's just how it is. It's just the cost of capital and it's the cost of doing business. Before we close, I'm going to go ahead and leave you guys with a wisdom one-liner. Proverbs chapter 14 verses 15. The simple believe anything, but the prudent give thought to their steps. Think before you do, guys. Thanks for tuning in to this KuCoin DigiDive. If you guys enjoyed this video, make sure you guys go ahead and hit that like, subscribe, that bell button. There's a link in the description below if you guys would like to get 20% off trading fees. And if you'd like to view some of our previous videos, there's one here, and like there. We'll see you guys in the next one.